In the bond market moment, the stock market is proving to be a volatile place to park money. Sean Dranfield, CEO of PTAM, PT Asset Management, is here. Great to see you, Sean. Bonds are often considered a safe haven, but what about the constant changes in interest rates?
Angie, thanks so much for having me on your show again. Really appreciate it. So this environment really only exacerbates the problem. Now, that said, what's very interesting about the bond market is unlike, say, 30, 40 years ago, when the market was very homogeneous in terms of the nature of bonds, we now have the emergence of so many new sectors in the bond market over the last 20 to 30 years. And what that does is it creates an ability for you to build a bond portfolio that can be divorced somewhat from interest rate predicting, because there are bonds that may do well if interest rates go up, and bonds that may do well if interest rates go down.
And what you see is what you get with bonds.
This is the beauty of a bond. So bonds are simply math. So with the stock, I don't know what a stock's price or its dividend will be in the future, but the beauty of a bond is they're mathematically knowable. So I know what the coupon or the price of a bond will be in any future interest rate environment.
What are some bond investing suggestions?
So if we embrace the idea that rates are unpredictable, in a rates down environment, we think that 18 to 20-year treasuries, some longer taxable municipals, and increasingly tax-exempt municipal bonds could do quite well. And in contrast, if rates go down, shorter structured credit like CLOs, ABS, and some CMBS structures that may be a little bit longer, we think can perform quite well in a rates up environment.
Thanks, Sean, for helping us out today.
Angie, thanks so much for having me again today on your show. Wishing you and your viewers all the best.